Hello, it's Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for August 23rd of 2026. Starting off the chart pack this week, we have the Atlanta Fed GDP Now estimate. You can see here that we've had some further degradation in that, although from an aggregate standpoint, estimates still remain fairly strong. Latest reading was about 4.3. Current reading for third quarter of 2026 is about 4.0. You can see here the second quarter wound up, in its current revised state, just under 2%. And then, of course, first quarter a little bit weaker there, closer to 1%. We had industrial production numbers here. It was in total maybe a little bit less than expected, 0.2%, looking for 0.3 here. If you back out the automotive sector, you get 0.4%. You can see how this tracks over time. This is showing really a couple of good data points here, particularly in the ex-motor category. And if we break that out between consumer goods and business equipment, you can see business equipment, which includes, say, call it computers, peripherals, things like that related to AI. You can see that that remains fairly strong, whereas in the consumer area, a little bit weaker. We talk about import prices, obviously as we're tracking this related to tariffs and trade, and a lot of trade policy uncertainty in the air right now, particularly this last week with Canada, a lot of back and forth there. We've got import prices, which remain somewhat elevated, although a little bit off their peaks. Year over year, about 6% here on import prices. Month over month was down slightly, and that's accounts for that little downtick there. And if you look at export prices, about 8.2%. Month over month was down, and again looking for about 0.2% positive on the monthly number. We wind up getting over 1% on the negative. So data kind of rolling off of its top, but you can see here clearly prices elevated relative to near-term history. We talk about the Philly Fed manufacturing index that came out this past week. Really good data point here, and this shows in a diffusion index here. When you get past 40, that's really strong. And then you look at new orders, maybe like slightly off their peak, but this is a really strong number when you think about it. And of course, leading into the pandemic, we were used to 20s and 30s oftentimes, but on the wholesale kind of positive data, and then the data has turned a bit more noisy. And then we went through our manufacturing recession on the new order side, also looking at that from an index perspective, but latest data clearly encouraging. We'll have a couple of other data points related to Fed financial conditions. You can see here still, when you look at this index here, you've got tightening conditions that are reflected in anything above zero, looser, and anything below it. Right now, the conditions seem to be still relatively loose, but tightening a little bit off of its trough here. Again, you don't see this trough, persist very long. We've had, this will be the post-pandemic period right here. Again, I would consider that to be an anomaly, but usually when we see this thing troughing out right around here, it reverses a bit. Now, you kind of translate financial conditions into really consumer financial conditions, and where we are on the mortgage rate here, we're about 6.7%. You can see that that's moving higher. Interest rates moving a little bit higher. We've got 10-year bond yields that, as we've been watching throughout essentially the balance of at least the last quarter, if not the last 6 months here, continuing to track higher. And so the gap between those two is about 2 percentage points or 200 basis points. And again, not necessarily great for savers, but when you look at it from a multi-year standpoint, we've got these mortgage rates that are extremely kind of sticky sticky in this broad channel here between like 6 and 7.5%. Atlanta Fed inflation expectations. Obviously, want to continue to monitor this as an important variable in policy, both as it relates to monetary policy, as it also relates to capital markets and real estate, commercial real estate, and quite a few other things. Capital spending being one of those. Right now, those appear to be somewhat anchored. Again, looking at it on a multi-year basis, kind of backing out the peaks and the valleys and the noise, tracking about, call it 2.1%. This is 12-month unit cost expectations. And this is obviously, if you're a large Fortune 1000 business executive, you are paying attention to this. On this slide, we have some same-store sales number from Wal Mart. Stock sold off this week. Walmart obviously being a barometer for consumer sentiment, consumer spending here. And as it is defined, same-store sales is really, sales on a per store or per unit basis relative to a year ago. And so when you look at in-store, which is by far and away the bulk of the sales here, you see a negative print to the tune of about 2.5%. And then a smaller component of overall sales is e-commerce, say small but growing, and it has been growing for 20 years now. But the e-commerce side remains relatively high. But when you factor in the gravity of in-store sales being negative, overall numbers were a little bit disappointing. And as we watch, consumer sales and consumer spending has tracked relatively strong over the last year, and maybe a little bit stronger than folks would have thought with tariffs, et cetera. But obviously, a lot of people kind of hanging on this data point and hoping that it doesn't turn negative. But when you see negative same-store sales on the part of one of your major retailers, it does cause you to take note. On this slide, we have an update related to capital spending for AI. Not a surprise here, just really just an update. And the multi-year expansion is providing both a lot of optimism as well as some degree of skepticism that free cash flow is going to be able to support this level of spending growth on the part of the hyperscalers and all of those within that ecosystem. You as can see here, the breakout between basically the raw compute spend for computing power and then overall data centers, and then the power that infrastructure that's going to be needed to help support that. This slide, we have a quick check-in on the housing sector. We've got pending sales that remain in a pretty strong funk here. So this is very emblematic of what's going on in housing right now. And as we've already talked about, mortgage rates are increasing with interest rates tracking the 10-year yield, which has gone up, as we know. So that's putting really a lid on affordability. And at the same time, you've got builder sentiment that is wavering. You've got housing starts here, which are in a bit of a downtrend. Here, you can see multifamily's been up. You can argue that we've had a little bit of overbuilding with easier credit in years past, providing an oversupply, which in turn is driving rents lower right now. So multifamily, again, may look a little bit more positive on the surface, but there are some negative underlying trends there, particularly with regard to rent. But this is the real story, single family. Again, it's positive data, but it's negative growth. And you can see the impact of that on pending sales relative to a longer historical backdrop. Talk about small business. This is actually pretty encouraging as well, because we've got hiring intentions that are moving higher. Here we've got basically profitability growth for small businesses, which looks like it's breaking out here on a multi-month trend. So these data points related to small business, which as we know accounts for the overwhelming majority of the economic growth in this country. It may not seem intuitive, but small business is certainly the backbone of our economy. Good to see these data points here as well. We have a few things to talk about on this slide. First of all, we've got nominal GDP growth. We've talked about real GDP growth, and we've got on a year-over-year basis. This is essentially a 5-year kind of moving average, if you will, and then you've got the 10-year government bond yield, which, as we've been talking, has moved higher. We've got the core PCE deflator, which is a proxy for inflation, that has moved higher. Those are two very well understood things. 10-year government yield, which we know is beginning to break out a little bit stronger, and then oddly enough, stock prices continue to move higher, particularly in this time frame in 2026, where we've had interest rate increases. And I will say that as we prepare to tread into talking about the investment markets, that higher overall interest rates do provide a headwind should it continue to stock price growth. We have a chart here from Charlie Bolello that kind of really speaks to the virtues of being invested. I know there are some people that feel trepidation in the stock markets. As you can see, it doesn't always go up. You tend to have some type of episode, corrective episodes in the stock market from time to time, but the bias long term is up. And so, like, the alternative is to keep that money in cash, but when you inflation adjust that, your purchasing power has actually eroded. And you go back to 1996, and that dollar of savings that you had that you stuck under the mattress is now really worth about 47 cents. So this really speaks to the value of having those dollars invested, not necessarily entirely in the S&P 500 here, but invested in a diversification basket, which is going to provide you better overall long-term purchasing power than if you just held all that money in cash. Now we'll talk about the S&P 500. We do actually see the multiples continuing to drop a little bit. Your average down here, a little bit less than 15 times. Numbers, maybe right at or real close to 20 times. We did peak about 23 times. So again, not as expensive as we were, but a big reason for that is the earnings growth. And I will say that this is a real thing. And but I will caveat by saying that the growth in earnings does feature a fair amount of concentration. And what that means is that we've had a lot of S&P 500 constituents that have not had this kind of growth that are lagging behind in terms of earnings, but that's been more than offset by, we'll call it, more influential members of the index that have a much higher, much larger market cap that are witnessing really strong growth. And so high earnings growth, which is the denominator in the price to earnings ratio. So when you have higher earnings and prices that might be meandering up a little bit, but earnings moving higher than prices are, that's when you get this multiple contraction here. Percent of stocks with dividend yields that are greater than the 10-year Treasury. This really just speaks to the growth of the overall market. And so when you have a really strong market, your dividend yields drop. And what's notable here is that, basically you've got to go back a really long way. I mean, this is like in the days before the global financial crisis, which we had these, I'll call them kind of like relative income spreads, really just kind of blow out, so you saw a deviation that persisted here in this time frame, largely because we had interest rates that were relatively close to zero, and in which case many more of the dividend paying stocks were obviously yielding more than the Treasury, because the 10-year Treasury was very, very low. With 0% short-term interest rates, long-term rates were very low. Now that has reversed with interest rates moving higher, market remaining elevated. This can be a contrarian signal, meaning that it could signal more volatility in the market. But it is something that that we have seen before, but you've got to go back essentially 20 years to see it. Now we'll talk about the margins that I alluded to before. So you look at operating margins in the blue. This is on the left-hand scale, so we're tracking a little bit close to 15% right here. You've got this is the S&P 500 op margin. Then again, you've got that same data point here that's plotted against core producer prices minus unit labor costs, which tracks this. I'd say there's a reasonable but not exceptionally strong correlation between these two data series. And so you can see that producer prices moving higher at the same time that you've got operating margins moving higher, which is a little bit interesting. And then you slide over here, and then you've got hyperscaler EBITDA margins, and this is the big what if. And when the market has sold off here recently, it's been because of some increasing skepticism on the part of these very influential large members of the S&P 500 index on whether or not that trend is going to be able to continue. So here in this dark line, you've got EBITDA margins, and question is that going to continue to move from, call it 40 to 50%, here in the next 4 years, and that's a big what if. And I'm not here to answer that question for you, but when you back out Amazon, it still looks pretty strong. And then EBITDA margins, or excuse me, EBIT margins here, the difference between depreciation and amortization really recognize the fact that we've got a lot of capital spending on the horizon. Another interesting data point here for Macrobond really kind of looks at the U.S. Profitability relative to the rest of the world, and as you can see in this chart very clearly, U.S. is basically generating an increasing share of the overall global profit picture. It's not to say that foreign firms are not profitable. It's just that U.S. firms are more profitable, and you can see that the weight of the U.S. within the total OECD is dramatically increasing over the last couple of years. So with all this talk about profits, I came across this slide, which is very interesting. And if you're a small business employer that may be still able to generate relatively good margins despite this, this is something that you definitely pay attention to, and that's healthcare costs for your workers. And we know that we've had a very mobile workforce over the last several years. Quit rates remain, have been high at times, not necessarily right now, but there was large incentives to change jobs for pay. Now, benefits is another hook to try to increase retention if you're a small business employer, but those costs are clearly going up, and the rate of gain, I'll just focus on this blue line here, in year-over-year healthcare plan costs are about 11%, and you go back to 2020 or even pre-pandemic, that was 4 to 5%, still ahead of overall inflation, but 11% is clearly a multiple of what we see in inflation right now, and really presents, in my opinion, one of the largest headwinds, because you think about overall labor cost for a lot of small businesses, particularly in the service sector, are 60, 70, 75% of your total overall cost structure. And this is a key component in that if you want to maintain a competitive workforce. Optimism remains pretty high in the market. I'm not going to show you the active investor and the individual investor numbers this week because they really haven't changed that much. But this research here from B of A kind of reflects what's going on in both of those charts, particularly on the institutional side. You see basically fund managers are maintaining very, very low levels of cash right now. And you can see that the equity allocations have really spiked and almost to levels that that I would say are a bit of an anomaly here. And on data series here that goes back to 1999, you can see that overall equity allocations are about as high as we've seen during that time frame. and with cash levels being very low. Again, a lot of optimism in the equity markets right now. So again, talking about the equity markets, it's important to kind of understand the internal dispersion within the S&P 500. So, what's reported in the financial press and kind of what we think about, like on the surface when we talk about, quote, the S&P 500 index is really the impact of the large firms that have an outsized influence. We talk about the largest 10 firms that are roughly about 40% of the index, and they're extremely influential on how you kind of view that index. Now, when you look at these charts, which I think are all impactful, this is the number of stocks that are trading with a negative beta to the S&P 500. And think of this as this, that typically, you do see some deviation between the constituent members, and think about, the S&P 500 as being 500 stocks in that index. And, it's not uncommon to see, one stock go a different direction than the other. But to put it in layman's terms, it's, there's a lot of dispersion. There's a lot of stocks that are not moving the same way as the index right now. And that's what this chart indicates here. And so when you talk about correlation, and this is the basically your AI basket, your hyperscalers versus really the rest of the S&P 500. And this chart is just kind of giving you a picture very similar to this, but in different terms. So this is just basically showing you your correlation between the rest of the index is very low, which in some respects is good for diversification if you're picking within the index. But if you're just picking the overall index, just be clear that there's a lot of difference between the largest firms and what's going on with the rest of the index. And this chart is the last one I'll show you. And so the correlation between the high risk firms, which are, I'll call the hyperscalers and the high growth companies, versus the low risk, those are clearly going in different directions. So I'll sum all of this up by saying that the index has a fair amount of internal dispersion, like the volatility of the individual stock within the index is much, much higher than the index as a whole. We were talking a little bit about multiples and how earnings have actually brought those multiples down. You can see that again here, that back in October of last year, we're talking about 23 times. Again, not a surprise, but I think what this chart shows you is that at different periods of time, you have different kind of, we'll call it rating mechanisms. And so right now, stocks are more highly rated. Again, 20 times represents here. If you go past go before the pandemic, basically you had at no time in the 12 years preceding the pandemic did we have a multiple in the market of 20 times. In fact, the average multiple from 2008, which is the aftermath of the global financial crisis leading up to the pandemic, was about 15 times. And so we can say that after the pandemic, stocks have largely been re-rated, with the exception of 2022, which we know was a very difficult year. And that was a period of very high inflation and a lot of tension related to that with the fear of interest rate increases, et cetera. But again, there are different moments in time. We like to think in terms of historical data helping to inform us on what might happen in the future. It's also good to know that there are a lot of things that were going on here that aren't going on here, and that basically the valuation mechanism for the market it was a lot different back then, and coupled with the fact that the constituency of the index was a lot different back then. Right now, we've got a lot more influence from the hyperscalers and very high technology focus. Back here, we had much more of I'll call it an industrial or cyclical focus for the S&P 500. So another thing we've talked about benefiting our stock market has been the influence of foreign investment. And again, one of these things that kind of goes into the camp of I wouldn't have expected this. when we had the tariff tantrum, and all of the uncertainty with regard to trade policy that has come henceforth from that. And but still the U.S. market, particularly with the dollar, has been a very attractive area for foreign investment. And you can see, like going back to 2000, that you see increasing swings of investment. And again, 2022 markets were very tough. A lot of disintermediation, a lot of foreign disinvestment, and that happened again in 2024. But since then, we've had a tremendous influx of international capital into our markets. A quick comment on the gold markets. We can see here the multi-year run-up in gold. We talked a lot at the beginning of the year on the run-up in gold and how it peaked over $5,000 an ounce. Honestly, just got ahead of itself, in my opinion, and accordingly did sell off as it probably should have. But there were a lot of reasons why it ran up as a store of value, and also a lot of reasons why it did sell off. But now we see gold has perked up again. It's punched through its 200-day moving average, which is this dotted line here, which from a technical standpoint is actually a relatively bullish signal, because usually when you punch through that 200-day moving average, you tend to continue moving in that direction for a while. The sentiment on the potential for further gold price increases seems to be corroborated here in this sentiment indicator, B of A's fund manager survey, which measures the amount of those that are saying gold is overvalued. And so, when you look at it through a different lens, you've got 16% that say gold is essentially undervalued, and that's a relatively high number. So when you marry this recovery here with this type of sentiment indicator, it would tend to suggest that you're going to continue moving in a northward direction for prices. So the alternative conversation here is on the dollar. Dollar has been weak, it's remained weak. We've seen oscillation around this line here. You can see that just as gold was just punching through its 200-day moving average on the upside, we've got the dollar that's moving on the downside. A lot of this is kind of tied more recently to issues in the bond market and some of the actions that could be taken by the Treasury to repurchase those securities, thereby kind of flooding the market with dollars and driving the dollar down, and obviously increasing the price of those bonds, providing a demand price push, which would then in turn reduce interest rates. So there's a lot of questions over whether the market believes that that is going to work, and we'll talk about that in a second. But meanwhile, we've got the dollar, which has taken a few legs down from its interim increase from the beginning of the year. I spent a lot of time recently talking about the federal debt and its impact on long-term growth and the legacy that we're leaving for future generations that are going to have to wrestle with this debt. You can see here clearly, just in really call it the last month and a half, that we've gone from $39.4 trillion to over $40 trillion of public debt. Now, a lot of has been made recently in the press about eclipsing that $40 trillion level. I think also what's equally as important is looking at it relative to our economy, the size of our economy. You can see here that we're way above pre-pandemic levels, and we've kind of reversed a lot of this progress that we were making following a lot of the stimulus payments when essentially the economy shut down for a couple of months here. But we've gotten profligate again, and we continue to increase. Now, this is a spending problem that's translating into the issuance of more debt, and it's just, we're going to talk about this a little bit later, but it's creating a very difficult issue, not necessarily for this year, next year, but in the coming 5 years or so. Certainly in the next 10 years, when you talk about crowding out issues with government spending because you've got more debt, and that interest on that debt is moving higher. On this slide, we'll continue our conversation about the national debt. Looking at it over several different presidential regimes, you can see national debt really began to accelerate during the Bush administration, and obviously we had the war on terror and 9/11 that continued through Obama and Trump, and then we had the pandemic, which it really affected both of these numbers. So the rate of gain in debt has really accelerated. And this is particularly concerning, but suffice it to say, this also tells us too that there's really no bias to, whether you're red or blue, both parties are just as guilty about this increase in debt right now. And this is really kind of reflective of a spending issue. It's not really anything other than that. And you can see here when you talk about money supply, this is a topic that particularly in the years that were leading up to and during the high inflation periods of the 2020s that we didn't spend enough time talking about because we had some tremendous increases in money supply. And you can see the aggregate numbers, really, if you get past the, or get into this current century with the wars and the various issues that we've had to deal with, that, both parties are just as guilty on a rapid expansion of money supply. With everything that's already been said with regard to fiscal spending, fiscal deficits, the increase in national debt, sticky inflation, and policy uncertainty, this has all led to what we see here, and that's an increase in the Treasury yields to around the 4.7 range. And what we see here as well is that with this volatility in Treasury rates, it has also come an increase in volatility. And we've talked about this a lot, and this is part of the attack on that traditional 60-40 model, when you just assume that you put 40% in treasuries, which you did back in the 70s, 80s, and particularly 80s and 90s, and it worked for you just great because you had that diversification and it actually worked. But correlations have really picked up since then, and at various times bonds have been highly correlated with stocks. And we've seen that volatility figures for U.S. related fixed income have actually picked up quite a bit. When you have increased volatility and increased correlation at the same time, that's not necessarily good. Interesting thing here is that is certainly not the case with the international backdrop. Just an interesting development here in the context of higher overall rates. This is probably the best exhibit I can show you here, the 30-year yield on really how the issues that we've been talking about have manifested in the market. So when you talk about high deficits, high government spending, sticky inflation, policy uncertainty, deficits that are having to be funded through Treasury issuance, and declining share of treasuries that are owned by central banks, kind of your more stable buyer. This is all leading into what we see here is a reversal of that trend that we saw for quite some time leading up to the pandemic, and that was a overall decline in interest rates. That has obviously reversed itself, and we see here that 5.3% is a level that we haven't seen in a relatively long time here, and it just speaks to all of this uncertainty. So there's a risk premium that's being added to markets now, and so it does make longer term financing a lot more expensive. And so particularly if you're the federal government funding treasuries, you're having to pay more on that, which is a further burden on your fiscal deficit, and it crowds out other government spending. And it also creates some issues related to cap rates on commercial properties values. And other types of financing has just become more costly as a result of this overall regime. And again, over the last week, we've had a lot of conversation. Secretary Bessent at the Treasury was talking about, instituting a repurchase program designed to try to help bring these rates down. The market kind of sniffed it out and said, well, we don't really believe you, or we feel like, okay, this might be a short-term elixir, but it doesn't solve the long-term problem. And ultimately, these rates are reflective of kind of this cognitive dissonance that exists with regard to the ability to rein in federal spending. We've spent some time talking over the last few months about how foreign central banks have reduced their share of U.S. Treasury holdings. And in fact, they bought more gold as part of their reserve package. And you can see here in this line right here, this represents foreign official holdings of treasuries. That continues to go down. At the same time, the Fed has done purchase programs in the past, qualitative QE, qualitative easing, so to speak. And foreign private holders have actually picked up their share. But the biggest change here that we've seen amidst, and again, going back to 2015, 2016 is that inflection point of domestic private owners of treasuries have far eclipsed the foreign central banks. And this is a much more volatile buyer. This is a much more speculative buyer. I mean, this is a much more strategic buyer. And so you're replacing a strategic buyer of treasuries with a more speculative and potentially volatile and an investor class that might be more reactive to behavioral biases. It just sets the stage for more volatility within the treasury market, which we just talked about. And if this were to rein in, being very well aware that foreign central banks continue to decrease their holdings, you're going to have to find a natural buyer of these. And if there's any shakeup or degradation in the demand from domestic private buyers, that could be a real problem and lead to even higher interest rates, not lower. Some more information on bond markets. We see here that inflation expectations, which is a part of all of this. We've got 10-year yields moving higher, which are in turn are driving real bond yields. That's net of inflation, and then we've got TIPS, the break-even rate, which is kind of the imputed inflation rate for 10 years is now about 2.25%. I'm actually a little bit surprised that that is not higher. This research from MRB Partners tends to suggest that it is going higher because these two items are moving higher. But suffice it to say, this is all part of the conversation that needs to be had with regard to interest rates, deficits, and potentially the impacts on capital financing and borrowing costs out in the market. Long government bond flows. With the increase in long rates, we've seen a tremendous inflow of new capital in there, and that's not surprising. Obviously, capital is seeking a home, and you might make an argument that that higher bond rates, with the 30-year moving past 5.1, 5.2%. Might be a little bit, call it oversold, and that could be a reason for a lot of this. But again, increased gyrations in the fixed income markets right now as a result of all of this policy uncertainty. Government corporate debt moving opposite ways. This is interesting. You could kind of in some respects call this kind of a crowding out. But you got government debt moving much higher at the same time that corporations really by and large, again, long data series here, but by and large, from the beginning of the century have, improved their balance sheets, have taken debt down. At least this is, debt to profit ratios. So, they've cleaned up their financial situation at the same time that government has stepped in and more than filled that void. Here we have business development companies. A lot's been said over the credit markets, and BDCs have really taken the brunt of it, particularly the publicly traded ones. A lot of redemption requests, a lot of concerns over the quality of loans, particularly within the software sector. You can see here that 2026 is shaping up to be a relatively benign year for fundraising within the business development community sector. And in a but in a related way, you talk about like collateralized loans, and this is what this really speaks to CLOs, collateralized loan obligations. We've seen a lot of fund flows in here. So where there is security, there is demand. Where there is not as much security in business development companies, there's not as much demand. So this will be something I expect will play out, continue to play out over the next year. Well, that's all we have for the chart pack this week. Hope you've enjoyed it. Have a great week, and we'll talk to you again soon.